Hi, everybody. Thank you for tuning in and joining. Today is Thursday, April 11th, and it is a rainy week here in Georgia. Um, sorry for the poof. It's just what happens when we have sunshine and rain in Georgia. If you live here or are thinking of living here, that is definitely something to consider because if we have warm days with any rain, you might as well just put your hair on top of your head because there is zero reason to style it whatsoever. But I had a listing photography shoot this morning, so had to try and put my face on a little bit for that. Got to work with the best in the business shooting that. So I'm excited for that listing to come up. You guys will probably see it. But I've got some interesting things to go over with you guys today on the show. So definitely want to stay tuned for that. But first, let's see who's in. I'm done with this rain. Betty Ayers, I am with you. It's been raining every day this week. Quite frankly, we could probably use the rain a little bit because the pollen last week was literally about to kill me in the sinus region. However, I feel like a couple of days rain is great and then we can move on. And that just doesn't seem to be happening. Although I do believe that come Sunday, we'll have a little bit of sunshine left. I don't know about you guys, but I'm full blown ready for summer at this point. I'm tired of the cold. I'm tired of the rain. I'm tired of all of the things. I just want to have some sunshine, get some vitamin D. So that being said, let's dive straight in because this first thing might be a little controversial. You guys take it for what it's worth, but you know that I always tell you when I get on here that I'm going to share all of the information with you, and that way you can make the best assessments because I feel like our media kind of sugarcoats things in some areas and then they blow other things completely out of proportion. So this is one of the things that I feel like was just kind of swept under the rug. And I feel like it needs a little bit more attention. So we're going to bring it to it right here. So Blackstone, if you're not familiar with Blackstone, definitely Google it. Lots of great information on this lovely company. But let's just say that they're buying up the American dream. They are constantly buying up all of the affordable properties that are in the US. And so they own quite a bit of property throughout the United States. Like I said, Google them, get a little bit of information on that. But so right here, this article talked about Blackstone is betting that property prices will go up, and they're putting their money where their mouth is by purchasing a trust that owns apartment buildings for about $10 billion. So they are putting up $10 billion to buy these apartment complexes. So, I mean, I feel like that kind of tells you something. BlackRock is one of the ones that I've been telling you that we should be watching out for. I feel like this is one of the culprits that is kind of behind a lot of the things that are going on right now. I think it's a lot of the reason why we don't have affordable housing options. If we have these deep pocket trust investors that continue to buy up all of the affordable options, how are everyday people supposed to get them? When you have deep pockets like that, I don't feel like it is a fair trade. And so I would definitely say that one of the things that could be done, instead of giving buyers $5,000, why don't we say that investors can't buy anything else for a little while, or that they have to sell off a certain amount of properties so that we can have some options. But hey, I don't get to run the country. So it's just my 2 cents. And I definitely thought that it was interesting. And I wanted to make sure that it didn't just, go by the wayside on you. Make sure that you saw that and know that it's there because it's good information. And like I said, if you're not familiar with Blackstone, I would definitely go and take a look at them because it's interesting stuff. So this is the next one that I wanted to talk to you guys about. So the latest inflation numbers, they are in and they came in higher than expected. So what does this mean? Well, the big numbers from the data released yesterday in March, inflation rose 3.5% from the year before, and it's up 3.2 in February. So the core CPI reading, which excludes food and fuel prices, came in even higher. And that's the same as in February. But this time they say it's serious. So what is the difference? Well, I think they were kind of maybe thinking it was a fluke a little bit. And then they realized maybe it's not. So consumer spending has not really tapered. And with inflation going up, those numbers just continue to rise. So why is it such a problem? Well, after seeing inflation fall by 3% over the course of 2023, which is what they were kind of hoping for over the season there, represented a hiccup. Fed officials believe that higher inflation readings in January and February, like I said, represented a hiccup. However, with the March reading also coming in hotter than anticipated, they say that this is more than a fluke. So what does this really mean to us? Because all of that is just a lot of words and information. What that really means is what I've been telling you guys all along. We're not seeing rate cuts. We're not going to see rate cuts right now. I will be surprised if we see them in third quarter. With the way things are going right now, I just don't think that it's going to get to that point. There were 200,000 jobs added on. And I know that that sounds like a good thing. And in a lot of ways, it is a great thing, but the job market is really strong. And so if the job market is strong, we have really low unemployment, which means rates are going to continue to stay elevated. So I don't know if you guys keep up with it or not, but rates were all over the place this week. Wasn't a fun week. Thank goodness we're not doing like 7%, 8%, anything like that. But it was just kind of wavy. Couldn't really tell where things were going to land. But we're still at that 6.5 to 6.7 range, just depending on your credit score and some other things. So low unemployment, that's a positive. Higher rates. It's got to kind of balance out. So I don't know. Let's take a look. So the big thing that I wanted to go over with you guys today is I've had a lot of people asking me recently about assumable mortgages. Obviously, with rates as high as they are, if you were able to take over someone else's rate that was lower, even at 4%, that would be a really positive thing. So I think a lot of people hear about these assumable mortgages and are like, hey, that's going to be for me. And they don't really understand what's on the back end of assumable mortgages. And so I think it's something that's really important that you understand everything that goes into it. If you watched my live a couple weeks ago, I feel like this is something that should actually be kept with the seller, because it's one of those things where if I'm selling my home and I have a 3% interest rate, or if I'm thinking of selling my home, if you told me that I could take my 3% rate with me, put it in my little pocket, and then go to my next house and put it on there, I would be all for it. And don't get me wrong, I understand that now I need to qualify for the new house, yada, yada, yada. But if I do qualify for the new house and everything looks good, I don't feel like the interest rate should be tied to the property. I feel like it should be tied to you, because it was your credit score. It was your W-2s or 1099s or whatever that qualified you for that interest rate. So why are we tying the mortgage to the home? Why are we not tying the mortgage to the borrower? But again, I don't get to run the world. If I did. But so with that being said, you don't get to take the mortgage with you. You get to get a whole brand new mortgage. So why aren't people selling right now? Well, because they don't want a whole brand new mortgage. They want their 3% interest rate, or even lower in some cases. So with that being said, this was an interesting read, just talking about the assumable mortgages, because I feel like this is something that a lot of people really want to get into or think about. And it's just not that easy. So with the assumable mortgages, some of the details, you've got pros and cons. So the pros, obviously, you're getting a lower rate. There's lower upfront costs because they're not starting all over with a loan. There's a shorter loan life. And then there's long-term savings. So the cons, very, very few people qualify for this, and we'll get into why. The lenders can be slow to act on this, again, because it's a little bit risky. They're not going to offer this up as a first option. Buyers must use the seller's lender. So because obviously you're assuming the mortgage, you can't just go out and get your own lender. You have to basically take over where the sellers were. So if they were with Wells Fargo, you'll be with Wells Fargo. If they were with, something else, Atlantic Mortgage, then you would be with them. And then last but not least, the buyer might need a second mortgage to cover the home's increased value. So this is where it gets a little bit tricky, and I don't think that people understand how you really take over somebody else's mortgage. Usually you have to have a substantial down payment in order to take over that mortgage. The only way that you wouldn't have to have a substantial down payment is if maybe I just bought the house and then, a couple months later I'm selling it. In this case, that wouldn't really do you any favors because we were at 6% a couple, months ago, and now we're still at 6%. However, if we were in a lower market, then, it would be different. But if you were looking at getting a 2 or 3 or even 4% interest rate, you're going back to early 2022. So since then, the seller has been paying on the property. And so let's say that they've paid it down, and I'll give you an example here. So first of all, what types of loans are eligible? FHA loans, USDA loans, and VA loans. So FHA loans are, just a basic loan. USDA loans are for agricultural properties. No, it does not mean that you have to have a farm. I get that question often. You do not have to have a farm. You don't have to have cows, chickens, any of those things, but it does have to be zoned agricultural. And most of those properties you're going to find more in rural areas. And then VA loans obviously are veteran-backed loans. So very specific loans that are going to be for this. So what's in it for the buyers? Well, there's a lower interest rate, obviously, with today's interest rates kind of between 6 and 7%. Obviously, it can be a bigger incentive. The fewer upfront costs. So since you would be assuming the other mortgage, like I said, you're not having to do a new loan. So you're not having to pay those upfront mortgage insurance costs. A shorter loan life. So basically, if the seller already has paid in, let's say that they bought it, this example here, if the seller is 8 years into a 20-year mortgage, you're only going to have the remaining 12 years of that mortgage. Most of us do 30-year mortgages. So keep that in mind. And then long-term savings, you get a more detailed rundown of your potential savings with the mortgage calculator because you're paying less money over time. That being said, what's in it for the sellers? Well, if you bought your home at a substantially lower rate, then basically what's in it for you is the fact that it looks good to potential buyers that they possibly could assume this loan. The key factor there is the buyer then has to qualify for this. So really the only thing that's in it for the sellers is it could be a marketing tool, but with that marketing tool, you have to make sure that you say that you're a well-qualified buyer with a lot of money to be able to put down on the house. And that's not going to be for everybody. So I think that's going to be a small pool there. Looking at this though, any other watch outs? So yes, even if everything else lines up, another thing to consider is the responsibility, because the original mortgage holder could still be held liable if the assuming party defaults. So what does that really mean? Well, if I'm selling my property and I'm letting someone else assume it, let's just say Joe down the street assumes my loan. If he defaults on that loan, I could still be held responsible for what he was supposed to be paying. I've sold it to him. I've sold him the house. He's assumed my mortgage, but because it was mine originally, he's now still held responsible. It's like having your fingerprints left at the murder scene that you didn't commit. It's just not a good situation. So I'm not a huge fan of these. I'll be honest with you. Very few people are going to qualify for these. And one of the big things that I think is very interesting, so only about 6% of listings are eligible. And like I said before, they have to be FHA, USDA, or VA, but only 6% of listings are eligible. That is a very small percentage of the listings. So realistically, you're looking for a needle in a haystack to be able to even find one of these options. Then the interested buyer has to meet the qualifying criteria of the original loan. So basically, the situation is, let's say that, I bought the house originally for $500,000. Now it's worth $600,000, but I've been paying on that loan. So now my loan is only for $450,000. Well, if I'm selling that property to you for $600,000, my loan that is left on there is $450,000. You have to pay the difference from $600,000 to $450,000. So that's where that hefty down payment comes in. Because if you're assuming the loan of someone else, you have to pay, you have to cover the gap of whatever you're buying it for and what they still owe on the property. So if that's a $300,000 gap or a $400,000 gap, which in some cases it can be, just depending on how long this person has been paying on the property, then for you to assume that mortgage, you have to put down a substantial amount of money. So let's just play with things and say that somebody bought a house in early 2022. And so they were still able to capitalize on that 3% mortgage rate. And then now all of a sudden we're at 6.5. You don't want to do that. So you want to look at assuming their mortgage. Well, if they paid $500,000 and they have that 3% interest rate, they've been paying on that house for basically 2 years at this point. So let's just say that they've paid in $60,000. Well, now you are responsible for coming up with that $60,000. So in some cases, when it's a more reasonable amount, maybe you have that saved up, right? Maybe you had a large down payment you were going to be paying anyways, or maybe you've sold your home in another state. You have a large amount that you're coming here with. This may work for you, but you're also going to have to find the sellers that are able to do this. And then you have to be able to qualify for the original loan. So you have to meet all of the terms with your credit score, with your debt to income ratios, with your W-2s, 1099s, however you get paid. You have to meet the criteria of the original loan that was 2 or more years ago to be able to make this work. So there's a lot more detail that goes into the assumable mortgages than I think people really grasp or think about, and nobody ever really breaks it down. So I felt like it was something that's important to do today. So let's answer some questions. It's classic. I love it. Total sarcasm. As always, I tell you what's garbage. Loan went to Sam's Club, got 6 items, and it equals $93. So actually gas here today just got up to $4 a gallon. I don't know how much it is in other locations, but for us, that is a bit excessive. I'm not appreciating the $4 a gallon. I'm going to need that to go back down. Why would a seller agree to this? Carl, that's a great question. Really and truly, the only reason that a seller would agree to this is if they're needing to sell their home and this is an option from their mortgage company, because also the mortgage company has to agree to it. So if the mortgage company agrees to it, you're a solid buyer, you qualify, everything looks good, you've got the down payment money, and the lender is good for it. Then if you're needing to sell your home and you feel like this person qualifies, then the benefit would be, it could be a good tool to offer to buyers, right? If your home maybe is sitting on the market for a little while, it's not getting as much traction as you had hoped, or maybe you increase the price a little bit because you're letting them know, hey, I'll scratch your back if you scratch mine, right? So I'm going to sell it to you for maybe $10,000 higher, but you're going to be able to assume my interest rate at 2.5%. So really and truly over the life of the loan, you're making that $10,000 plus some back. So that's usually what we see is the seller is able to increase the value just a little bit on that offer or on that contract because the buyer knows they're making that money back over the life of the loan. Great question though. I don't like the sound of that type of loan. Yeah, for a buyer, it can be great. For a seller, I definitely think that there's risks that they need to understand and take on. Hopefully, if this is something that they're considering, hopefully their agent and their lender is educating them on all of this because I find a lot of times that doesn't happen. So making sure that you're looking out for your best interest or just watching my lives and I'll look out for your best interest. It all comes around. So there's always a catch or gray area with these. There is. And that's why that old saying, if it's too good to be true, that really falls in line with this. There's always a gray area. Now, I'm not saying that you shouldn't do this. Please don't misunderstand or misinterpret. Definitely not saying that you shouldn't do this, but I am saying that you make sure that you know all of the facts before you make a decision on it, especially if you're the seller, because if that buyer defaults later and then the bank is coming after you for the remaining balance, or now this is going to look like a foreclosure, on your name, you really don't need that hassle. So just something that to make sure that you're food for thought there. Is the seller informed they could still be held responsible if the buyer defaults? So, Kim, that's one of the things that I was just saying. Hopefully, their agent is educating them on that factor. Um, I have found that a lot of people these days do not do their due diligence, they do not do their research. And so they're just like, sure, that sounds great. If I get a little bit more money for my house, why wouldn't I do it? They're not educating themselves, and you can't rely on someone else to do that. So make sure that you're looking this up, or that you have an agent and lender that you trust to talk to you about this stuff. More your agent than anything, because at this point in the game with your lender, your loan could have been sold off. If you bought the property through, let's just say, I work with my lender, Tyler Pate, he's here local. And if you bought through him and then a year down the road, Wells Fargo bought the mortgage from, his company, and now you're with a large company of Wells Fargo, well, you're a dime a dozen, right? You're just a number in a sea. And so do you think that you're going to have a Wells Fargo person that's going to walk you through this transition? I'm going to go with probably not. I could be wrong, but I've never had great experiences with them. So we'll just run with that. So you really need an agent that's going to walk you through the process, make sure that you know what's going on, make sure that you know the benefits and the risks, because that's the only way to make an educated decision, is if you know both pieces to the puzzle and you can really decide, like, is this worth it for you or not? In many cases, again, this is why I feel like that the rate should be able to go with the seller. They've already qualified for it the first time. I totally am for them getting qualified for it again at the new property. But if they do qualify for it, then let me just keep my rate. None of this would be an issue. I would be on the hook for my own loan. We're not assuming it to anybody. I'm keeping it. I'm still the person. So whenever the government decides to get it together and take me up on my offer, please let me know, because I think this is a fantastic thing to do. I've talked to multiple sellers and they're all like, yeah, if I could take my rate with me, I would move tomorrow. But at some point, there comes a time where if you need to move, you've outgrown your home, it's just not working for you and your family anymore, you just bite the bullet and make the move. Because going back to my previous slide, I don't think that we're going to be seeing interest rates coming down anytime soon. I will be surprised if we even see them third or fourth quarter this year. I hope I'm wrong. Like I've said before, I don't think I will be. None of the numbers and the statistics that we have in front of us are showing that we're going to have a reduction. So I can only go by what I'm seeing. And like I said before, I think it's a great thing that job employment, employment is up, unemployment is down. I think that's an always positive thing. However, that's also adding to, the fact that interest rates aren't coming down. Inflation as a whole is not really doing us any favors, though. So hopefully we'll see something with that come down. Right now, I don't think we're going to see any differences, but it'll be interesting to see third and fourth quarter with the lovely elections, what we see come out. So that's brilliant. Yes. Have you found any sellers willing to do this? I actually had one that was willing to do it. They were needing to move to Chicago for a job transfer. It just made sense to them to go with this process. We talked to the lender that held the loan in detail to find out everything that might be a risk to them. They had the ultimate decision. I obviously educated them on both sides and gave them my thoughts. At the end of the day, as a real estate agent, all we can do is educate you. We're not really supposed to give you our opinion. However, I do anyways. But the thing with that is, at the end of the day, it's up to you. We work for you. So I've told people all along, I don't think you should waive contingencies. If when I'm writing the offer and you say waive the contingency, I will do as you please, because this is your contract and we'll write it as you see. But for them, it just made sense. They were able to get a little bit more money on the sale of the house, which helped them get to Chicago. And it was a tool that we were able to use to get a buyer quickly because the husband had already moved there and was living there. Wife and kids were still here. It was a stressful situation. They didn't want it to drag out. And this was just something that was able to help them in that situation. And they felt like it was a positive. So most sellers don't really want to assume the responsibility of if something were to happen, it could come back on them. So have you ever had anyone buy a house straight cash? Yes, absolutely I have. I think the most expensive one that I kind of choked on a little bit, it was very early on in my career. I think I was only like 25 or 26 years old. So I had a gentleman write a check for about $1.5 million cash right there at the table. This is back when we actually did checks at the table. You don't do that anymore. It's a wire transfer. But this was back, 2005, 6? And so he wrote a check right there for $1,500,000. And I thought that was just loads of cash to write a check for. So yes, I've definitely had people buy a house straight cash. I actually have one closing on Monday that will be buying straight cash. It was not $1.5 million. This is actually a really sweet story. It's a couple with 2 kids. They bought their first home, probably 10 years ago. They stayed in it for quite some time. They ended up selling in 2021. They rented for a little while. They've been wanting to get some land, a house with some land. We've been looking for a while. Finally, we found the perfect one for them. It's about 10 acres. So they've saved all of the proceeds that they made on their home. They stuck it in a drawer and they've held on to it. And now they're going to be closing on Monday in cash, totally free of a mortgage. So it definitely pays to have real estate because now this is affording them their next home. So they could have taken that money and bought a larger home, scaled up, but that's not the vibe they were going for. They're actually in a very modest home that fits exactly what their needs are, but they're on 10 acres in the middle of nowhere. They've got a barn, they've got a tractor, they've got all sorts of fun things that you have when you're in the country. So yes, tons of options. Wow. Yes. That's crazy, bro. Just wrote a check like it was nothing. Big Daddy. I definitely thought so because to see a check for $1.5 million in 2005 at the beginning of my career definitely was like, wow, I hope I get to that one day. But it's amazing because he got there with that $1.5 million by, again, real estate. He had bought and sold a couple of different options. He ended up selling 3 properties all at the same time, took all of the proceeds of that, and then bought this one particular property that he and his wife had been eyeing for some time. It just lined up perfectly for them. So I'm not going to keep you too long today. I wanted to just get in your head and kind of tell you the things about assumable mortgages because I know it's in a lot of people's forefront with interest rates where they are right now. And it sounds like a great option. And for some people, it might be. But like I said, educate yourself on all of it before you make that decision. I hope you guys have a wonderful, wonderful evening. I hope it stops raining here. And I will see you guys next Thursday at 7 o'clock. Thanks for tuning in.